Hey everybody, again, Mitch Ferraro from F Street. Super excited to be here. I'm the investor relations manager, and we're going to be talking about the private debt fund today. I always like to give people kudos that are on the call today. This is your education to learn more about investments that we have here at F Street. So I always like letting people know, this is your destiny. This is what you're doing to make sure that your wealth that you're building is done correctly and you're doing your due diligence. So thanks for being with us today. Today we're going to talk about the private debt fund. The private debt fund is a very straightforward fund, and I'm just excited to be able to talk to you guys about it. All right, so kind of getting right into it. F Street, just in general, for those that may be here for the first time or seeing this for the first time, we're an alternative real estate investment company. If you've seen our owner and founder, Scott Lurie, before doing webinars or anything like this, you hear him talk about planting money trees. That's what we do here. We're trying to help you build long-term wealth, generational wealth through some different verticals, and all basically going through real estate. And here's how we kind of plant those money trees. We've got a few different verticals. We have our private debt fund. We have our industrial development and acquisitions. And we also have our multifamily development and acquisitions. Today, we're going to focus on the private debt fund. That is our 10% annual return note. It's a great fund for passive income, and we'll get right into that. So the private debt fund, listen, it's as passive as it gets. You provide us with an investment and you receive money every single month on the last business day of each month. It's a 10% annual return. It's like clockwork. It's been around for 16 years. It's been a proven method to produce passive income for yourself. Again, a lot of people, when they get into real estate, they think it's going to be this passive investment. Those of you that have a rental portfolio or some other type of portfolio, you know that you're actively typically managing that portfolio. With the private debt fund, it's not active. It's completely passive. And the monthly distributions, which is really nice, is that it can be either sent to you every single month and you receive that ACH payment from us, or we do have a compounding feature inside the fund where instead of receiving those payments, you're actually having that interest compound on your principal every single month, which allows you to grow your investment faster. So how does it work? This is how it works. Every single month, you receive an interest payment from us. So a simple example, if you put in $100,000 into the private debt fund, you would receive $833.33 every single month. And it's, again, like clockwork. This fund has been around for 16 years. Scott Lurie, the owner and founder, he started the fund with about $700,000. He's grown it to a $100 million fund today. He's never missed an interest payment ever in the 16 years that this fund's been around. So it's a great, great way of a proven track record of a fund that you know you're going to get that investment every single month. At the end of the year, you receive a 1099 INT. That's a tax document. So this is considered an interest payment. It's basically considered like normal income. You're taxed at your normal income tax rate. There's no tax benefits in this fund. And that 1099 you receive from us by January 31st every single year. Also, there's a 90-day return after that 1 year. We only hold the investment for 1 year. After that 1 year, you decide if you want to keep your money in the fund and continue to earn that 10% annual interest, continue to either receive those payments, or if you're compounding it, continue to have them compound. Or you can say, hey, Mitch, you know what? I would like all my money back after that 1 year. We do give ourselves a 90-day period after you make that request, but typically, if investors are requesting like $500,000 or less, you're typically getting that back within about 2 to 3 business days, but we do give ourselves a 90-day period to return those funds. So here's a really cool compounding feature. We actually just started this back in June of 2024. The compounding feature is a great, great way for someone to increase their investment, their principal investment, at a much faster pace than just receiving that interest every single month. You'll notice in the first year on this chart here, you're receiving an additional $471 inside of the private debt fund if you have it compound versus receiving the payment every single month. And that is on a $100,000 investment that you would have. Now, what's nice about that compounding feature is that a lot of our investors will use this feature if they're using what's called a self-directed IRA. You can do it if you're not using a self-directed IRA, but you're getting the most benefit by using the compounding feature in a self-directed IRA. Now, this is an IRA where you have full control of where the investment from a retirement account goes to, and you're also shielded from that 1099 INT that you would receive at the end of the year, and you're actually just growing your money quickly, much more faster than you would versus just receiving that money every single month. Again, if you're doing it through a self-directed IRA, that's great because you're getting protected from that 1099. And the reason that is because it's a retirement account. You're actually not seeing that money. It's going back into a retirement account, and you're actually then just having that money compound every single month. So this is a great, great feature that a lot of our investors use. We have some investors that do it through themselves individually as well. You can do that. But if you do it through yourself individually, you will still receive that 1099 INT at the end of the year. This is just a little bit something from last year. You know, we paid out to investors over $5.3 million in interest payments. Again, 16 years that this fund's been around, we've never missed an interest payment. You know, our stability of being able to pay out investors is not based off of the market that's going on. So a lot of people that are in the stock market right now, you understand you're probably feeling some pain. You're feeling good days, you're feeling bad days, you're seeing the volatility of the market. That's not how it works for us here at F Street. And I'm going to get into a little bit on what that looks like and why we're able to pay the investors that 10% annual interest every single month. And for the past 16 years, that's what it's always been for our investors. It's always been 10% annual interest every single month, paid on the last business day of every single month. Again, just very, very predictable. And it's one of those things where our investors know and like seeing that every single month. Okay, so how are we able to pay the investors their 10% annual interest? We have a hard money company called the Hard Money Co. that we loan money out from that fund to real estate investors that are borrowing that money to basically flip homes or use what's called the BRRRR strategy, the buy, rehab, rent, and refinance strategy, to buy a property, fix it up, get it rented out, and then they basically refinance with longer term debt to pay off our short-term loan to them. So when we do that, we're actually going ahead and borrowing the money out at 15% in 5 points to borrow that money. And then we start the first term out at 6 months. So we're keeping the spread of the 5% and 5 points, and then we're giving the investors a 10% return to be able to receive that monthly interest payment every single month. Now, on the hard money side, every time we loan out every time we borrow out money, we become the first lien position on every single asset inside of that fund, or in every single asset that we loan out on. We're able to go ahead and actually, in that first lien position, if at some point in time a borrower was to default on the loan, like they weren't paying their interest payments anymore, they stopped communicating with us, we're actually able to take that asset over and then go ahead and either sell that asset on the open market, or we can go ahead and sell it to an investor inside of our network. Or if that deal is a good enough deal, we might go fix that property up ourselves and then resell it. So about any given time, we've got about 500 to 600 active loans out in the marketplace. Again, that means that we're loaning out to 500 to 600 active loans to properties that we have. And then at any given time, when we go ahead and get that money back from the investors, that's just what we are able to return to the investors and the 10% that we have. Okay, so this is kind of the business structure on the hard money side. So we do all of this in-house. So we have our own loan originators, property evaluators, underwriters that do all of this work for the Hard Money Co. We've got about 20 dedicated employees on that side. We do the marketing to bring in applications. We take in about 300 loan applications per month. We do all the underwriting in-house. We have our underwriters to make sure that those deals are good deals. So out of those 300 applications that we're taking in, we're loaning out to about 30 to 40 of those applications a month. So we're not just taking in an application and then loaning out to that person. We're taking about 10% of those 300 and then loaning out to them. We do all of that underwriting again in-house. They're making sure that when the loan comes in or when the application comes in, they're making sure that the after repair value is correct. They're making sure that the borrower is a good borrower. They're making sure that the scope of work is correct, that what they believe is going to be the total amount of repairs that they're doing is accurate. So we underwrite all of that to make sure that that is a good deal that we are going to get into. We then once we go ahead and loan out the money, we do all of the processing, we do all of the payments, all of the repair draws. So when an investor loans, when we give that money out to them, and then they want to actually pay for something that's done inside the property, we provide that draw. They provide us with the pictures of the actual work completed. We use a pretty cool piece of technology called TruePics. It's a geolocator that shows us that those pictures that are actually being taken of that actual property, so we know that those pictures are for the property that is actually being repaired. And then from there, we then draw out so that those guys can pay their contractors for the work that was completed. Again, if at some point in time, our borrowers, for some reason, this does happen, we're in the lending business. If our borrowers default on their loan, meaning, again, they don't pay their interest payments to us or they stop communicating with us, we do have the right to take that property over and go ahead and basically, because we're in that first lien position, foreclose on the asset. And then once we foreclose on it, we then can either, again, sell it on the open market, sell it to another investor, or go fix it up ourselves. We have a whole REO asset management team in-house that takes care of those types of properties for us. We do foreclose on about 2 to 3% of our loan portfolio per year. But what was really good last year was a really good year for us. We were actually under 1% last year. So, and that just goes to our underwriting. We're making sure that our underwriting processes are continually improving to make sure that we're getting into really good deals and we have borrowers that can continue to pay our loans off after they get done fixing up the property. All right, again, just the kind of key figures for the loan origination. Again, we're charging 15% for that money to be borrowed. We're charging a 5% origination fee. So again, 15% in 5 points that we're borrowing out to those borrowers to borrow that money short term. We start the first term at 6 months. They can extend to 12, 15, and 18 months if they need to. But if they do, we actually charge them another 5-point origination fee. So we actually make more money on the loan if they have to go past the 6-month term. And what's really nice, again, is that we're able to then pay our investors the 10% annual return. And again, that spread that we have of the 5% and 5 points, that's what drives and operates F Street. I will often get questions from investors that say, you know, you guys are making a lot of money off of the 5% and 5 points. Yes, we are. You want us to be profitable. You want us to make that money because that's what allows us to continue to pay the 10% annual return to the investors. And it happens like clockwork every single month. So yes, that pays the salaries, that pays any expenses that we have going on within F Street. So yes, you want us to have that spread because as that spread might get skinnier, that might mean that we're not as profitable. So you want us to be as profitable as possible. Yeah, so we just got paused for a question and we really appreciate the questions. Just roll them in if you're listening and you're like, that guy doesn't make sense. I don't know what the hell he's talking about. Just ask questions along the way. This question that we just had was about the compounding feature. Can it be turned on and turned off halfway? Yes, it can. You can, if you are starting out as receiving payments every single month and you all of a sudden say, you know what, I want to grow my money faster. I've changed my position in these past 3 months. I now want the compounding feature. It's super simple to do. At the end of this presentation, I'm going to quickly talk about our investor portal. The portal is an awesome feature. We've put a ton of resources and time into our investor portal to make it very, very easy for our investors to be able to do things like this and actually make their investments. So we'll touch on that. But yes, Simple question, simple answer. You can switch from compounding to being paid or being paid to compounding at any time. Yeah, so the question was, what does the redemption look like? And what was the run on the bank? We'll touch on this in a second. If I don't answer the question, just ask me to reiterate or ask the question again. Okay, so F Street's War Chest. So this is a really, really great feature that Scott uses as an additional risk mitigator inside of the fund. So the War Chest, we have $11.5 million on our balance sheet that stays on that balance sheet as owner equity, which is Scott's money, for the instance that at some point in time, we weren't able to pay the investors the 10% annual interest. If F Street were to ever have a month where we were in the red, we wouldn't be calling up our investors to say, hey, this month we cannot pay you. We would pull money from the $11.5 million to be able to operate the business as it normally would operate and to continue to pay the investors their money. We have never had to touch this in the 16 years that has been in this, the fund has been around. And this continues to grow. Every single year, what Scott does with this fund is he takes 50% of the proceeds that he makes in the fund and pays taxes. The other 50% goes into this reserve. So he's always building that reserve every single year from the profits of the business for himself so that he can sleep better at night knowing that that's in reserve if at any point in time in the future, because again, we don't have the crystal ball, we don't always know what's going to happen, that he can still pay his investors and we would have time to pay our investors off of that $11.5 million reserve. So you may not see this in a lot of different funds, but this is just a personal thing that Scott has done for this fund to help mitigate risk or to help us portray to investors that we also have skin in the game, that we're doing something that we want to make sure that our investors know that we're trying to mitigate risk as best as possible. Where is it? So you're asking, someone asked where the $11.5 million was, where it's invested. It is invested in a few different portfolios. If you would like us to send information on where that is diversified, reach out to me, mitch@fstreet.com, and we can give you that direct information. All right, so let's go to the next slide. Okay, profit asset oversight. So this is basically talking about the asset management, loan extensions, foreclosures, REOs. I just like to kind of reiterate on this feature that we are in the lending business. We know that there are going to be borrowers that default on their loans. Things happen. Sometimes, investors, something happens to them or they totally, maybe it's their first time and they botch up doing the actual rehab of the house. This happens. And a lot of times when that happens, Scott does his best, and Scott is so entrenched in the business. He's the one person that will go in and talk to these borrowers and say, hey, what can we do to help you? How can we get you to get this loan paid off? How can we get you to get across the finish line to either sell this house or refinance the house? If that does not work, we then go into the foreclosure process, and we do have that REO asset management team that then goes ahead and takes over, forecloses on the home, and that is a process as well, depending on if it's a judicial state that we're in or a non-judicial state. And I think this is a great time for me to kind of say where the loan portfolio is at. About 50% of the loan portfolio of those 500 to 600 active loans that I talked about, 50% of those are in Wisconsin. The other 50% is basically throughout the Midwest. So Illinois, Indiana, Ohio, Michigan, Minnesota. The Great Lakes region is really our bread and butter. We do have other sprinkled loans in different states like Missouri, Florida, Tennessee, but the Midwest is really our bread and butter. We are looking to expand into other states. We're doing that very methodically to make sure that our underwriting processes are working correctly. But we do go through those different states to make sure the foreclosure process can happen. And once again, once we can take that asset over from a borrower, we then get rid of that asset through a few different means of either selling it on the open market, selling it to an investor, or fixing it up ourselves and then reselling it. I will also say, Just because we are profitable each month does not mean we've never lost money on a deal. We have lost money on deals before. It does happen. But as an aggregate, actually over the past 6 years, as an aggregate, year over year, we've actually made money on the foreclosures. So the foreclosures are actually a net profit center for the business. But that is as an aggregate. That does not mean we've never lost money on a deal. But we do a really good job of trying to mitigate that loss as best as possible. Oh, wrong way. Sorry about that. Okay. So, oh, I was going the right way. I apologize. So our open equity opportunities, besides the private debt fund, I did just want to touch on, we do have our Oak Creek property that we're just finishing up. We have about $1.3 million left to raise in that deal. We are looking to finish that raise probably here in the next, we want to try to finish it up by the end of April. We've got $1.3 million. This is a great deal. This is on the multifamily side. This is another one of those seeds that you're trying to plant with the money tree. This is a great deal. We're looking at just under an 18% targeted IRR, 8.75% cash on cash, 1.87 equity multiple. If you're looking and staring at these numbers and you don't know what those mean and you want to learn more, because this is a really great investment. This is 57 units that we're developing right on Lake Michigan. It's the third phase of a multifamily project. We've already built 199 units. That's fully leased up. We're building 75 units right now, and we plan to start construction on this one in May to do the last 57 units. So if you are considering multifamily or considering diversifying your portfolio through real estate, through different types of verticals, please reach out to me on this. Again, Mitch@fstreet.com. We can explain it to you. We can also get some of our development team on the line with you. One thing I think we do a really good job here at F Street is we really try to make sure if someone is interested in a deal, but maybe they don't necessarily understand what a deal may look like or what a multifamily deal may look like, we do a really good job of educating our investors to make sure that they understand the deal and if it might be a good fit for them. Also, we do industrial acquisitions. As of right now, we have none that are open. These are, we're very bullish on these types of deals right now, and they raise very, very quickly. This month, we have raised a lot of money in different industrial deals. Typically, these are in tranches of like $2 million and $3 million raises, and we're able to raise those typically in less than 24 hours because they're very, very good cash flowing assets, meaning that they're producing cash flow right away when we close on the deal. They also produce K1s, which is like you receive a 1099 INT in the private debt fund. On all of these equity deals, you receive K1s. And what we typically do on the K1s is we do cost segregation studies, which allow us to forward accelerate depreciation on the asset, which then allow us to show a passive loss on the K1, which then allows us for investors to use those passive losses against passive gains that they've done in other real estate or other passive gains that they've done in their portfolio. So won't get into technical details about that, but our industrial deals are very, very good deals. They raise very, very quickly. If you're like, hey, I kind of want to see what these deals may look like, you can visit our website, fstreet.com. I highly suggest signing up for our investor portal. There's no obligation to invest with us, signing up with the investor portal, but it will give you firsthand access because you'll now be basically a part of our ecosystem and you'll see these deals come up as soon as they come up. So if it is something that you're interested in, you can act quickly if it is something that you need to act quickly on. Okay, I did want to just quickly touch on our investor portal. So at fstreet.com, you literally in the top right corner, you can click sign in. It allows you to go ahead and sign up for the investor portal. Very easy to sign up, email address, your name, and then we then have your information to send you deals for any deal that may come up. Also inside the investor portal, that's where you're going to be making all of your investments. There's a very easy tab on there that says offerings. You click on offerings. You see all of the investments that we currently have, and then there's an invest now button. You click that, you fill out the information, you tell us how you're going to make the investment, and then you invest. It literally takes 5 to 10 minutes to sign up for the investor portal and to make an actual investment. The other biggest thing is that every investor that comes into any of our funds here at F Street, they must be an accredited investor, and we must verify you as an accredited investor. That's also very simple to do. You can do it through the investor portal. We use a company called Parallel Markets that verifies that. You just upload information to them. It takes them about 1 business day to go ahead and verify. And then once you're verified as an accredited investor, you then can invest with us for the next 5 years. And this is a must. If you're not verified as an accredited investor, you cannot invest with us. And I'll quickly tell you what an accredited investor is. There's 2 criteria. You only have to meet one of them. One is through your net worth. You have to have $1 million or more, not including your primary residence. Or you can go through your income. If you file your taxes solely, you have to make over $200,000 a year or more, and that has to be that way for the past 2 years. Or if you file your taxes solely with a spouse, you have to make over $300,000 a year or more, and it has to be that way for the past 2 years. So, and then all it is Parallel Markets verifying that information through your income or through your net worth. Once that's done, again, you can invest with us for the next 5 years. So that's all at fstreet.com. You can sign up. We'd love for you to sign up. We'd love for you to get accredited. Again, no obligation by doing any of those things. It's free to do. And I always just suggest for people to get accredited, because once you become accredited, you can invest in any platform that needs accredited investors. We're not just the only platform that needs that. There's a ton of them out there that need accredited investors, and then you can invest in any platform. So I will stop there. I know that was a lot of information. I know it's kind of all over the map a little bit, but we're going to take questions right now. Please ask any questions that you have. If I don't have the answers right now, I would love your contact information, because I will follow up with you to make sure that you get those questions answered. Yeah, great question. So what happens if applications dry up coming into F Street? Like, what happens if there's a recession? To be quite honest, we see applications go up during a recession. Reason being, we are a lender. When a recession happens, money dries up. When someone may have 5 options for lenders, when a recession happens, they now may only have 2. And we are one of those options. We still have funds to be able to loan out during those times. Typically during recessions, there are a group of people, it's millions of people, that look for opportunities in housing during a recession, because they know they could probably buy a house at a cheaper price than if we were in a good economy. So they come to us when when a recession happens, for that money. So if applications do dry up, and even in we do really good in a good economy, we do even better during harder times, again, because we're a money facility, and we're basically always open for business. Yeah. So the question was, if you invest in the private debt fund, can you invest in other deals? Or, oh, sorry. So the question was, does the fund, do we commingle into the equity deals? And that's absolutely not. We do not commingle any funds. The private debt fund is its own fund that loans out to borrowers that are buying single family homes to either flip them or use that BRRRR strategy. On the equity side, every single deal that we do on the equity side is called its own special purpose entity, SPE. So when you go on our website and we have a deal in Wheeling, Illinois, you'll see F Street Wheeling, Illinois, LLC. It's its own special purpose entity. You're directly investing in that equity deal. That has nothing to do with the private debt fund, and the private debt fund does not loan any money to those equity deals. Is there a redemption fee? There is no fees tied to the private debt fund whatsoever. So once your 1 year is up and you want your money back, you just make the request through me. I let our accounting team know, and then we return those funds to you. So there's no fees attached to this. You're getting the 10% annual interest. You're receiving that monthly payment. The only fee that there is from the government when you receive that 1099 INT at the end of the year, and you have to pay taxes on the interest. All right, so that's all the questions that we have for right now. I'm going to stick around for just another minute. If anyone else has any other questions, please let us know. Again, I really appreciate everyone's time today, taking 30 minutes out of your day to check this out, learn more about the private debt fund. Again, big kudos to anyone that's seeing that. You can reach me at Mitch, Mitch, at fstreet.com. Again, thank you everyone for your time today.